I'm Kurt Anderson. I'm the CEO of Fair, Anderson and Langerman Certified Public Accountants. The purpose of our discussion today is to talk about planning for the ultimate sale of your business. Actually, the most important thing you can do in selling your business is to set the stage for that sale down the road. First issue is what drives the value of your business. Looking at the value of the business from an industry standpoint, from a cash flow standpoint, what are the drivers that make the company valuable to someone else? Understand those early in this decision-making process. Secondly, take a look at the tax structure that you have to make sure that it's optimal for an ultimate sale of the business. As an example, if you're operating in a C Corp environment, that typically does not work very well from the standpoint of maximizing your tax advantages of the sale of the business. Typically, buyers want to buy assets of the business, not corporate stock, and subject themselves to unknown risks, contingent risks. So having your business run in some sort of a pass-through entity such as an S Corp or an LLC typically is more advantageous than operating in a C Corp environment. Planning ahead allows you to set the stage legally and tax-wise to optimize the ultimate sale of the business. Secondly, look at whether you're developing an internal sale or an external sale. Frequently, a business is valuable from an industry standpoint to third parties, but also can be valuable to the employees that run the business on a day-to-day basis. The common theme in both types of sale is that an excellent, well-run management team is critical to either sale. If you find that a third-party sale is the way to go, your management team in place running the business profitably and well is going to help maximize value and allow the purchaser to pay you the most money. If you decide to sell on an internal basis, you more than likely will be financing a part of that sale, and having a well-run organization with an excellent management team is going to make you feel much more comfortable selling the business to those management team members on some sort of a time basis. What's the company worth? Again, I mentioned earlier, industry valuations sometimes are available. If there's not an industry valuation that you know of, then having an appraisal done of the business to understand what drives the values is very helpful at the beginning stages of looking at selling the business, not just at the time that an actual transaction is going to occur. Again, understanding what drives the value for your business and how that becomes valuable to a third party is critical in setting the stage for the proper sale of a business enterprise. One of the things that happens too is that people act almost like they're selling a car when they sell the business. They think, well, I'll enter into an agreement, I'm not going to give anybody any information whatsoever until they make a non-refundable deposit on the sale of the business. Well, it doesn't work that way. It really doesn't. And if you think about it, a buyer has to have some idea of what they're getting into, what the organization is like, and what kind of profitability there is. So early on, planning that you will have to give information to a buyer, that there is confidentiality that's important, and that there's an effect on ongoing operations that you're going to be concerned about, because you may not want all your employees to know that you're thinking about selling the business. That's important to consider and plan for. But to assume that you'll get a buyer to buy your business without giving them any financial information is unlikely. There are 3 C's of a business sale, the most important aspects. The first is culture. The second is culture. The third is culture. And I know this sounds odd when you think about other issues such as value, cash, tax issues, legal issues. But the reality is, in most business sales, whether it's internal or external, that corporation that you own has to be merged into or melded into some other organization or continue on some basis. And if your employees can't merge well with the culture of the third-party acquirer, or if your employees don't have an ongoing culture that's strong enough to support purchasing the business from you, then your sale is not going to be successful in either event. So when a third party looks at buying your business, look at the people, understand where they're coming from, understand what drives their values in running their business, even if it's similar to yours. How do they treat their people? What are their attitudes towards employment issues and health and welfare issues? See how they match up with yours to make sure that if there's a sale, it's going to be successful, everyone will be happy after a transition period, and you will get the maximized value for your business. Now, whenever you sell a business, there are financial issues, and there are areas of misunderstanding that crop up frequently. The first one is the question of what's the value of the business, and when you're talking with a buyer, are they talking about an enterprise value or are they talking about an equity value? They're not the same. Frequently, sophisticated buyers particularly, will look at the enterprise value of a business, and fundamentally what they're talking about is the value of the assets of the business less ongoing trade accounts payable and those types of accrued liabilities. So they might be talking about a number which in their mind means you will get X number of dollars for the sale of your business. You have to pay off all your long-term debt and equipment-related debt, and the residual is then what you're left with. That as compared to equity value, when they say the value of your assets less the value of all your debts, accrued liabilities, accounts payable, long-term debt, etc., is X, and we will pay you this for the equity. There are two different calculations. And strangely enough, it happens frequently that a buyer is talking about enterprise value, a seller is talking about equity value, and it's not until we get into documentation of the deal that all of a sudden the misunderstanding rears its ugly head, and we find out that the purchase price is millions of dollars off from what the seller truly expected. Whenever you're doing a sale transaction also, terms and conditions come into play. You know, if there's going to be an installment payout, frequently there are holdbacks where there's a contingency fund placed that certain amounts can be tapped by the buyer if certain unknown liabilities occur or if certain assets turn out to not be worth what they thought they were worth, such as accounts receivable, things of that sort. So this is not uncommon in a business sale at all. There are significant legal issues in selling your business. First of all, make sure you get a good lawyer. And I didn't say get a lawyer, I said get a good lawyer, one who's not a deal killer, one who understands the give and take in negotiations and is really focused on what do you want from this sale transaction rather than trying to argue and cajole the buyer into every little thing for your benefit to the point that you disincent the buyer to continue negotiations. The lawyer needs to be realistic. You want to look at your customer base. Make sure that your customers would be comfortable with a sale transaction, either internal or external. Plan for the transition, plan for notification. In a transaction, there are employment contracts typically for key employees. Those contracts may or may not be similar to what you currently have with your employees. In fact, you might not have any contracts with your employees where the acquirer will want contracts. You'll have to think through how do you get your employees comfortable with that. There's non-competes typically, particularly for the key employees and the owner of the business. They don't want to buy your business and then have you go out down the street, set up a new company, and compete with the company they just bought. These are all standard concerns. As I mentioned early, planning for tax issues is critical. The proper corporate entity, whether it's an S-Corp, an LLC, C-Corp, needs to be determined early on to make sure that you get the maximized capital gains benefit. Remember also, in most sales, you do not get all your cash up front. There's a certain amount of money that you'll carry back over a period of time, so there's installment sale tax considerations involved in that as well. And then thirdly, or finally, there's life after the sale. And this is a concern whether it's an internal or an external sale. If you have an external sale, you and your employees are going to have to get used to someone else running the business the way they run it. Things will not be done the way you're used to running them in the past. Get over it. If it's an internal sale, you as the owner of the business have to be careful that you've got to let those people that you train to run your business do what they're trained to do without you interfering. You've got to give them their lead and let them go and run the business, make the decisions, make mistakes, hopefully not large ones, that allow them to become better and better at running that business because that's what allows them to pay you. So you can't continue to run the business after the sale if you truly want to have the ability to pull back, take your cash off the table, and do other things besides run your business 80 hours a week. That's the basic premise of what it takes to sell your business.